Hi, this is Todd Baker, your certified mortgage planner, and today we're going to go over how to read a loan estimate. The loan estimate is part of the initial disclosure package. It's normally not given out until you actually have a house under contract. So it's different than sort of the fees worksheet or spreadsheet or whatever kind of pre-qualification presentation that you were presented with when you were looking for and shopping for a mortgage. This is a disclosure that comes once along with your total disclosure package, and it has really, of all the disclosures, this is the one that has what I always tell people. This is the one that has the nuts and the bolts of the things that matter most to you as a consumer, right? What's your payment and what's your out of pocket, and it can be very confusing and intimidating to read. And what I found is that probably well into the high 90 percentile of loan officers don't explain this well, if at all. So let me go over this with you real quick. This is on a conventional loan. So a conventional loan would be a Fannie Mae or Freddie Mac loan. They can come with as little as 3% down on these loan types. Anything over less than 20% down will have mortgage insurance premium, or it'll be built into the interest rate. So let's go over here and how to read these elements. So first of all, these are all standardized federal forms. So you'll see the date, it'll have the date issued, it'll have your name and the property address, it'll have the sales price right here, it'll have the term, the purpose is a purchase, fixed rate, and then you can see the conventional, and then it'll show whether the interest rate is locked or not. That's sort of important because if you look there and it says no, and you're relying upon a certain interest rate, then that can change. In other words, it's not locked in. If the rates go up, then when they lock it, it'll worsen. So just keep that in mind. So here in this particular case, we're putting a larger down payment down. So the loan amount is $262,500. Interest rate's 5.625, and the interest rate only affects the principal, the monthly principal and interest. That's all. And keep in mind too that mortgages are already over 30 years, so the interest rate doesn't cause some huge fluctuation in payment by hundreds and hundreds of dollars. I get that question all the time, and it just doesn't do much of a change. I mean, the interest rates matter, of course. You want to get the right good deal, but you also want the right structure of a loan. That's super important. But this is all it controls: the monthly payment and interest. Next, you're going to have it'll show you your payment calculation. So you have your principal and interest. You have mortgage insurance. This one doesn't have any, but if it did, it would be right here. And the mortgage insurance premiums are based on credit score and amount of down payment. So the lower the down payment and the worse credit score, the higher you pay, unless for a conventional loan. Now, for the escrow, that includes your taxes and insurance. Escrows are mandatory unless you put 20% down. So in this case, and most people want them because it's the same cost whether you pay it monthly or pay it on your own. So then it'll have your escrow, your insurance, and your property taxes and your total payment. It'll show your estimated taxes and insurances and assessments. In this case, it's showing that there is a homeowners association dues, but they're never paid. Those are always paid separately. So that's why this 832 is higher than that 803. So if you see a difference between the estimated escrow and this number here, it's usually because that's including the HOA dues. Next is the estimated closing costs. This is one that really confuses people because people see that and it's always a large number, or at least in most cases, it is a large number. And it's because it includes all the closing costs, includes the ones the seller's paying, and it includes all the prepaids and escrow accounts set up without giving credit for what's called the tax proration. So in other words, this number is all in buyer and seller. It doesn't include credits you're going to get. So this does not represent what you're going to be paying out of pocket. That's just the total closing together. This will be your estimated cash to close after any credits given on page 2. When you go to page 2, it's going to detail in sections A through J the loan fees, or different closing charges, really is what it is. So on number A is your lender. These are your only lender fees. And if you're going to pay points, which is prepaid interest to buy down the interest rate, they'll be charged right here. You'll see there's a third-party fee, a funding fee, and then there's a processing and underwriting fee. So our lender fees are just $695 and $695. That's it. But most banks are going to be very similar. Services you cannot shop for is your appraisal. There's usually a credit report fee to cover the cost of pulling credit, and then the doc prep is for your loan doc fee. And those are usually around about $200 in the state of Texas. Section C is all of the services you can shop for, except that these are typically the title charges, and usually that title company is negotiated on your contract. So even though you can shop for them, if you've agreed to a certain title company, that's usually who you're going to go with. And you can see there's a survey. The survey is always required on a new build, but it is not necessarily required on an existing home if the seller has one and there's been no changes. The escrow fee is the charge you pay the title company to handle the paperwork. You split that, so this would be your half as a buyer. And the rest of these are various fees. The title insurance, which gives you clear insurance for free and clear title, along with all the endorsements. When you come up to the other side of this, you've got your deed recording fee, your prepaid. So you always prepay insurance for a whole year, whether you have an escrow account or not. You're also going to prepay your interest. The way mortgages work, when you close on a loan, it actually skips a payment. So in other words, if you close in March, your first payment would be due in May. And then you also have your escrow. Your escrows are set up. You're always going to have, here's how you figure this out very quickly. You always need 3 months for reserves. That's the federal requirement. And then you just add, so you have 3 months for insurance because you're already paying the first year up front. So 3 months going to escrow. And then this one was closing in February, this loan. So it was 3 months for reserves plus January, February, 5 months right here. So you have to collect that so the money is there in December when the taxes are due. But here's the thing. When you're buying a house, you are only going to own it from the time you close till the end of the year. So the seller has to give you a proration, which I'll show you in a minute. So then if there's an HOA transfer fee, there's also a buyer's portion of the title. And then you come down here to the total. You see the total closing, the down payment minus your earnest money deposit. And then you see here these credits. So you're going to get a credit for what's called the tax proration and the title. So in this case, the seller's paying for the title policy. There's a tax proration for the time they've owned the home, and they were also given a credit for closing costs. That's where all this shows up here, and then that nets you out at the $113,252. So that's how you read a loan estimate, okay? And if you're a buyer or a borrower watching this video, and your loan officer isn't really going in and educating you, they're not really empowering you to manage your real estate for the long term. Reach out to me. I'd be happy to help you. So thank you so much, and I hope you have a wonderful day.